What's up guys, Nick here, back with another video. Today we are taking a look at Amazon. We're going to figure out how good of a business is it, what's it really worth, and should you buy the stock right now? Let's take a look. Okay, so the first question we should always ask when we're taking a look at a business is, how is their financial health? Let's start with the income statement. So we can see if we look back to 2010, Amazon was bringing in $34 billion. If we look at how that grew over time, in 2019, they had $280 billion. So this shows a 26% year-over-year growth from 2010 to 2019. That is a very impressive number when you consider in 2010 they were already making 1.5 times NASA's current budget. You also see that the revenue growth has been pretty consistent and steady over time. It hasn't really gone up or gone down in any wild swings. Let's take a look at their net income. So we can see their net income is not as consistent as their revenue growth. Although we see a pretty big boom in the past 4 years, they really weren't making very much money between 2010 to 2014. What I found very interesting is when I went further into the numbers, Amazon basically divides their products into 3 separate categories. There's their North American sales, there's their international sales, these are their retail operations, and then they have a separate category for AWS. AWS stands for Amazon Web Service, and basically they rent out storage space on servers for companies so that they don't have to house very expensive and difficult to maintain servers on their own properties. As companies get bigger very quickly, it's difficult to project exactly how much server space they'll need, so if they can rent from Amazon, who has a nearly unlimited amount of server space, they don't have to be so concerned with making sure that they have the room for their data on their own servers. What I found interesting is when I took their net income but I removed the AWS numbers, I found that they still basically have continued along the same track, although in the past 2 years they've actually made quite a bit of money. But most of the time they really don't make much profit off of their non-AWS products. I've heard Warren Buffett talk about before that the best type of business is a business that takes no money to make money. So seeing Amazon's profit margins squeezed very small would be concerning. But if you look at Amazon's philosophy in their 10K, they actually report that they're not really concerned with their net income. They take all of their profits and reinvest them into their own business. So that's how they're able to grow out stuff like their massive shipping infrastructure and warehouses. So the next thing that we need to take a look at is their balance sheet. So Amazon reported in their last quarter that they had $221 billion in assets, $156 billion in liabilities, which gives them $65 billion in equity. If we take this equity number and compare it to their debt, they reported $63 billion in total debt. So this represents a nearly 1-to-1 ratio between their debt to equity. The ideal number that I will look for is 0.5. So for every $1 of debt, they have $2 of equity. Amazon's close to a 1-to-1. I consider this number okay. I would consider a really bad number would be 3 to 4 times equity. So 1 is an average number. Okay, so the last thing we're going to take a look at is their cash flow statement. Amazon reported receiving nearly $40 billion in operating cash. They spent $25,000 in investing activities, and they paid off $10 billion worth of debt. This gives them a net change in cash of about $4 billion. If we take a look at their free cash flow, they again reported about $40 billion in operating cash, and they spent $20 billion on capital expenditures. Capital expenditures are basically the costs to run their property and other physical assets. So it should come as no surprise that Amazon is obviously a very healthy company. They have a very high revenue growth rate, they have a healthy balance sheet with a debt to equity ratio in the acceptable range, and they have a very large positive cash flow number. So the second thing we need to consider is Amazon's moat. How resistant are they to other competitors coming in and stealing Amazon's business? I would consider Amazon's moat to be 2 things. The first thing is people have started to form a habit of when they hear about a product, they will automatically go to Amazon to start to research that product. According to 2 surveys back in 2018, they reported that 46% of online product research starts on Amazon versus 34% of product searches that start on Google. I know for myself that when I look up products, I tend to start on Amazon and then I'll research where's the best place to buy it from there. Typically, I'm going to weigh things like the shipping costs. Do they have free shipping? How quickly will it get here? Usually if it takes more than 1 or 2 days to get here, I'm probably going to pay a couple extra dollars to just get it off of Amazon. That leads me to the second part of their moat, which is an incredibly developed shipping operation. Until the COVID outbreak this year, I could basically order anything I wanted to 2 off of Amazon, and it's going to show up at my house in 1 to 2 days. I've ordered my computer chair, I've ordered dumbbells, I've ordered band-aids, batteries, big or small, any item, it shows up in my house in 2 days pretty much every single time. Creating an infrastructure to do this is obviously not cheap and not very easy for any competitor to come in and outcompete them in. The only real competitors that seem to be capable of competing with them on this are big retailers like Target and Walmart. But let's remember with this that 46% of product searches start on Amazon already. Not Target, not Walmart. Amazon has actually been working on more ambitious shipping speeds. They're trying to get down to a 1-day prime delivery. And to do that, they bought 50 airplanes, 300 semis, and 20,000 Amazon delivery vans for the last mile delivery. This is also going to reduce their dependence on FedEx, UPS, and the Postal Service to get the last mile delivery, the most expensive and difficult portion of the delivery itself. But all of this doesn't come without cost though. There are reports of very difficult working conditions at Amazon's warehouses. Some workers have actually reported that they've had to pee in bottles and forego bathroom breaks to meet up with the difficult demands that the Amazon warehouse workers are forced to work under. There's also been multiple protests at different Amazon warehouses because of the dangerous working conditions at these warehouses. So the next thing we need to take a look at is what is Amazon's intrinsic value. I take very literally what Warren Buffett once said, that the intrinsic value of a company is the sum of all of its future earnings. So what I do is I try to take the earnings that they most recently reported, estimate how much I expect their earnings to grow over the next 10 years, and then estimate what all of this income adds up to. I also subtract from that growth rate what is called the safe rate of return. I use 10-year treasury bonds for this number because I could invest all of my money into a treasury bond and the risk of losing any money in that investment is almost zero. But because bond rates are so low right now, you only subtract about 1% from the growth rate you expect a company to achieve over that time period. One quick way to take a look at what a company is worth is you take the price of their stock and compare it to the actual amount of earnings per share they reported. Amazon in the past 12 months has reported earning $20.93 per share. So based on the growth rate that I project for Amazon of 25%, I'm expecting a fair PE ratio of 87. As of today recording this video, Amazon has a share price of $2,692 per share. That means the current price of their stock is 128 times their earnings per share. So to me, that would seem like, based on their trailing earnings, the current stock price is too high where I would be comfortable buying. But there's a second thing to take a look at. What are they projected to earn in 2021, next year? Now this number is not a number that you want to rely on, but it tells you what the upside of the company is. This number can change very quickly and often does change very quickly as big events impact how the business is going to continue to operate. Right now, analysts are projecting Amazon to earn $37 per share in 2021. If we apply the price to earnings ratio of 87 to their future earnings of $37.56, we get a valuation of $3,267, or 20% upside by the end of 2021. This is not, again, something that I want to rely on to invest in, but it shows you what the potential growth is for Amazon if you were to invest in it today. But one other very important thing to remember is the value of a company isn't just one specific number. It's typically a range. If we were all to go out and take a look at what different people expect the value of Amazon is, we would all come up with slightly different numbers. But typically, this is within a small range. I also don't think it's always the best idea to just buy a company when it goes just below its fair value. That is the inflection point between where it's not worth buying and where it becomes more worth buying. The farther it gets from that number in either direction, the more you should sell it or the more you should buy it. Right now, I'm kind of getting two conflicting numbers. If I only look at their trailing earnings, so what they've already earned, I see that Amazon is about 30% over where it should be. But if I look at their future earnings, it has a 20% upside. I would say that Amazon seems fairly valued right now. It's not really undervalued, but I don't think that it's also incredibly overvalued right now. If I was looking to buy Amazon stock right now, I would probably wait for a better opportunity. The difficult part of this projection is really trying to figure out how COVID is actually going to impact Amazon over the next couple of years. If they have to raise costs to keep the warehouse workers safe, meaning they spread them out more, meaning they're paying for protective equipment for the workers, meaning they're slowing down their fulfillment rates, it's going to obviously impact the amount Amazon is able to sell on their website. They've had a lot of shipping delays between March and April, which no doubt has led to less people buying things from their website during that time period. With around 15 million Americans unemployed at the height of the coronavirus pandemic, it's not hard to imagine that people weren't buying as much stuff as they otherwise would have. Now, on the other hand, people not being able to go out to stores and being forced to buy things online may lead to more Amazon purchases than they would have typically gotten over this time period. If this leads to people seeing the convenience of sitting on their couch and buying things off of Amazon and having them show up in 1 to 2 days, it may change the long-term way of how people buy products in the future. I also know plenty of people who are just bored at home buying things off of Amazon that they otherwise wouldn't have bought because they don't have anything else to do during this time. I have seen no shortage of the Amazon delivery van driving around my house, and I've definitely seen no shortage of all the recycling boxes from Amazon out on recycling day by the curb. So just to summarize, I think that Amazon has fantastic financial health. I think they do have an incredibly strong moat, and I think right now the price is about fair value. It's not very overvalued, it's not very undervalued. Personally, I would wait for a better opportunity to get in, but if you did want to buy, I would just buy a little bit and wait for the price to go down more and buy a whole lot more. This way, if the price does run up a whole lot more, you don't completely miss out on all the potential gains you could get. Alright guys, if you made it this long, I really appreciate you taking the time to watch this video. If you could, please hit the thumbs up button, hit the subscribe button. I'm going to keep looking at businesses and telling you what I think about them. Thanks for watching.